Hi, it's Michael Farr from Farr, Miller and Washington. Thanks for joining me again this week. Number of things on my mind this week after Apple's sort of nothing burger of a launch yesterday. I understand that the speeds have increased and the camera's better, but my speeds have been fast enough, my camera's plenty good, and I've got to watch. So I'm not buying the gotta have it kind of excitement that we've seen in other launches in the past. I think that the markets were looking for something really exciting and titillating that they could sort of rally behind and take markets higher. Didn't happen. Apple downgraded today by a number of different investment houses. They're facing those laws of big numbers. When you get to be as big as Apple with almost $160 billion in cash on the balance sheet, that's an incredible number, by the way. I'm going to talk about that on CNBC later today. That's more than the market caps of companies like Kimberly-Clark and Walgreens and others. They could buy all of those companies just with the cash balance of Apple. Anyway, to grow earnings by meaningful percentages, they have to have huge and big numbers. I think the company will probably continue to make money. They're going to sell a lot of these new phones that will be profitable, but I think the sizzle has left the steak, if you will. Other news on CNBC's website today, and I don't typically tout CNBC on the website, but today I think they've nailed a couple of very important things. One, if you look at your screens, Wells Fargo's famous bear, Gina Martin Adams, has decided she's now bullish. Okay, that's one. The other one that's hugely important is mortgage applications plunge to a 14-year low. That's a really big deal. Two things. Markets are making all-time highs. The percentage of bears versus bulls, bullish advisors versus bearish advisors, has reached a high not seen since 1987. More bulls. We've never seen this percentage of bulls since August of 1987. When you see this many bulls, you should watch the other side of the street. Mortgage applications, as rates ticked up just a little bit, have fallen. So you can say whatever you want about all of these historically low interest rates, right? Because what the consumer is telling you is, hey, if it becomes more expensive, I'm not buying it, and they're voting with their feet. If the real estate market slows down, the economy continues to face big headwinds. The Fed meets next week, and they're going to talk about increasing the language about the next rate hike. I think they've got to be very careful because I think there's a lot of data in the market making a lot of news. Charlie Plosser, my good friend in Philadelphia, says he wants the changes to be data dependent. They better be watching the right kind of data. For now, the old rules are buy low and sell high. This is high. Not a lot of people have made money on the theory of buying high and trying to sell higher. Fortunes have not been made that way. So be cautious, be vigilant, do your homework, and if we can help you, give us a call at Farr, Miller and Washington. I've written about it this week. It's free on our weekly market commentary at www.farmiller.com. For Farr, Miller and Washington, I'm Michael Farr. Have a great week.